Do we need to see continued slippage or cooling in the employment situation in order for the Fed to get to that inflationary target?
Yeah, look, I mean, it's a good question because that's really the hard truth, and it's what the Fed has been very, very clear about. Look, the Fed has a 4.1% unemployment rate target by the end of this year. Now, that sounded kind of crazy up until recently when we got today's number. 3.8% puts us in the ballpark. Look, I think that the unemployment rate needs to get up towards the 4.5% level, which is very close to what the Fed's ultimate target is. Also, in order to get inflation anchored, and that's the key phrase there. In order to get inflation anchored, we need to see the unemployment rate continue to rise, further softening of the labor market, some cooling in wages. And this is all about the Phillips curve, right? The unemployment rate versus inflation, that inverse relationship between the two, which is what the Fed's primary MO is effectively, is they need to see the unemployment rate rise to slow wages in order to contain inflation. And I think that's the script.
And Jim, we heard from Powell saying they're navigating by the stars under cloudy skies. As colorful as that language is, for investors who are trying to say, okay, well, what do I do in this sort of environment when they're saying, obviously, 1 month of data does not a decision make? How should investors be positioning themselves right now?
Yeah, so that's a great question because, really what it tells us is that it's hard to determine. When Powell said navigating by the stars under cloudy skies, what he's really saying is that he's not sure himself. The Fed is not sure where the policy rate ought to be in order to stabilize inflation. It could be higher. Maybe it's just at the right level. What that tells us as investors is that the outcome of investments has two fat tails on either side, meaning that it could be that conditions are fine right now and that we're going to get a slowing of inflation and the Fed doesn't have to hike rates, which the equity markets, as we see today, view that as a very, very positive sign. It could also mean, though, that what if inflation doesn't remain anchored and that the Fed has to go more, then they will be prepared to hike even more, and that could be very, very negative. So what it tells an investor is that you really need to have a diversified portfolio. The way we see it is that fixed income looks attractive to us, but primarily in the front end. We think about an average of 3 years of duration makes sense in a fixed income for an average fixed income exposure in terms of duration. In terms of equities, look, we like the value sectors more than we like the growth sectors, but we also respect what growth can actually do. Growth has been very, very strong this year. It may set back and value may take over. So what we still like to look at is these value sector companies, which are trading on average with about a 15 PE multiple, so valuations are not crazy high, that actually say that if we have a softer or a mild recession, softer landing, mild recession scenario, that the value sector is actually poised to do very, very well in that type of an environment. So we think having good value equities and some high quality fixed income, but towards the front end of the curve.